So you have a home equity line of credit, a HELOC, and you're making payments on it, but you're wondering, is there a better way, a faster way to completely pay off your HELOC, save you money, and save you time in the process? So here in this video, I'm gonna show you a secret hidden feature that's in your HELOC that you probably don't know about, and if you use it, it will allow you to pay off your HELOC much faster and save you money and time in the process. By the way, my name is Sam Kwok, one half of the Kwok Brothers. I'm a certified financial education instructor, and I've been teaching finance and debt elimination strategies since 2016. And just in our channel for the last 10 years, we have hundreds of videos about home equity lines of credit, and I would argue our channel is the best channel to talk about this topic. So what I promise you by the end of this video is that you'll learn about the secret feature that's built into the HELOC, and when used properly, it would allow you to save a ton of money and time in the process of paying off your HELOC. So to get right into it, we have to understand how HELOCs work in the first place. A HELOC differs from your mortgage or even a home equity loan in the sense that it is an open-ended revolving line of credit. A HELOC, in the contrast of a mortgage, allows you to borrow money, pay it back, and any portion of the principal that you pay back is available for redrawal, meaning you can borrow back again, and the interest is only accrued on the balance in which you borrow at any given point. And just like a credit card, it has a credit limit, you're able to borrow from it, and as you pay back, it gives you availability and access. But one thing that is different about a mortgage versus a HELOC is how the interest is calculated and the timing of it all. So we can actually take advantage of this difference to be able to pay off our HELOC faster and save more money in the process. So what I'm gonna do is share my screen and give you a visual demonstration as to how the interest calculation is different than your traditional mortgage and how we can use this as the quote unquote secret feature towards paying off our HELOC faster. So here what we're looking at on the screen is an example of how mortgage interest calculation works. And the reason why I want to show you how the mortgage interest is calculated is to draw a comparison and difference as to how a HELOC interest is calculated. And it's in the difference where we can take advantage of that. So with a mortgage, let's just say, to keep things simple, again, this is just a visual demonstration to help you understand the concepts when it comes to the interest calculations and why it matters. But let's say we're working with a $10,000 mortgage at 6% interest, and in the middle of the month, we're gonna make a $1,000 principal payment to the mortgage, which results in a $9,000 ending balance. So we started out the month with $10,000 balance, 6% interest, and by making a $1,000 principal reduction payment, we end up with a $9,000 ending balance. So traditionally, with a mortgage, the interest is calculated on the ending balance times the interest rate divided by 12. And so what that gives us is something called a monthly interest. So it's not necessarily taking the 6% interest rate and simply multiplying it by the ending balance. We gotta take 6% divided by 12 months, which gives us a monthly interest rate on the mortgage. So we take 6% divided by 12 times the ending balance, and that ultimately gives us $45 of total interest. So pretty simple in terms of how the interest is calculated on a mortgage. And in case you're wondering, the red X right here is basically show you that is the last day in which you can make any excess or extra payment to the mortgage for the lender to calculate the final ending balance. So if you were to make any extra payments, say after the red X, say over here or over here or over here, it won't affect the ending balance towards calculating your total interest cost for the month. But if you were to make the extra payment before the red X, so let's say here or even here, then yes, that will affect the ending balance, decreasing it, subsequently also decreasing the total interest cost that you would pay at the end of the month. So I share that extra tip just in case you didn't know that. Most lender has their own cutoff date in which any extra payments you do make to the mortgage is going to factor the ending balance, thus reducing the total interest cost. Now, when it comes to the HELOC, a home equity line of credit, as opposed to using monthly ending balance for interest calculation, HELOCs use something called daily balance interest calculation. So here's where it differs from your traditional mortgage, where it simply takes the ending balance times the monthly interest rate, that gives you the total interest. With the HELOC, it's different that it is happening on a daily basis. So with same example, $10,000 starting balance, 6% interest rate, same $1,000 principal reduction in $9,000, but you'll notice that the interest amount is higher because of the daily balance. So what's happening is that every day, whatever the balance is, the bank is calculating the interest for that particular day. So as long as the balance remains $10,000 on a daily level, the bank is calculating $1.64 interest cost of the 6% every single day. So instead of taking 6% dividing it by 12, we would take 6% divided by 365 days, because that's how many days are in a year, and multiplying it by that specific daily balance. And the interest is calculated on a daily basis. So $1.64 is what the interest cost is, all the way till where we make that $1,000 principal payment to reduce the balance. Subsequently, it also then lowers the cost, the interest cost on that specific day. And because the balance is now at $9,000, not $10,000, we are being charged $1.47 every single day until the very end of the month. The bank will tally up the entire total interest cost and come up with $46.48. Another common form of interest calculation is going to be average daily balance. That's where the lender or the bank will look at how many days has the loan been at a $10,000 balance and how many days has it been at a $9,000, and it tries to do a weighted average. So it'll look at the loan and say, hey, the loan balance was at $10,000 for 15 days, and the other 15 days of the month, it was at $9,000. So take the average of the two in this case and say it's, the average daily balance is $9,500 and the interest that's being charged on the $9,500 ending balance, as opposed to either $9,000 or what the daily balance interest cost is. So those are two common ways that the lenders and banks will calculate interest on home equity lines of credit, in which in both scenarios, the total interest cost is going to be higher, right, than your traditional mortgage. So if we were to go back to the mortgage example, okay, let me actually move my toolbar around, there we go. If we were to go back to the mortgage example, you'll notice that we're only paying $45 of total interest, same interest rate, same ending balance. But because we're using daily balance or average daily balance, the interest cost is slightly higher at $46.48. And so looking at this, you might be saying, well, Sam, where is the interest saving? I mean, same starting balance, same interest rate, same ending balance, yet with a HELOC, we're definitely paying more in terms of the total interest cost. So it seems like a disadvantage to go with the HELOC as opposed to a traditional mortgage. But the same disadvantage, the same math that what appears to be resulting in a disadvantage can also be used as an advantage. So here's how we would use that same math to result in interest savings for our home equity line of credit. So instead of treating a HELOC like a mortgage, where you're just making one principal payment in a given month, instead, we're gonna leverage the daily interest cost calculation towards our advantage. So here's an example where we're gonna use that math towards our advantage. Instead of just making one extra payment towards our HELOC, we're gonna treat the HELOC almost like a checking account. So instead of leaving your money in a checking account, which really isn't bearing or yielding much interest for us, we're gonna use the HELOC to lower the average daily balance in a way that's gonna result in interest cost savings. So let's assume that our paycheck every month is $5,000, right? Paid on the 1st and the 15th, which is pretty typical. And with this HELOC, same parameters, $10,000 starting balance, 6% interest cost, and the same ending balance of $9,000. But what goes on in between is going to be radically different. And this is where the savings, a secret feature, is going to come from. So on the first day, let's say we get a paycheck of $2,500. Instead of leaving it on your checking account where it's really doing nothing, we're gonna go ahead and take that $2,500 and make a principal payment to our HELOC, essentially a deposit, quote unquote, and thus lowers our balance from $10,000 to $7,500. And by doing so, it lowers our interest costs for that specific day because HELOCs use daily interest calculation as opposed to monthly interest calculation with a mortgage. So as long as the balance stays at $7,500, it remains at $1.23 every single day, all the way until the next paycheck comes in at $2,500, and we're gonna do it again. We're gonna take that paycheck and make a principal payment reduction to our home equity line of credit, and therefore now it's at 82 cents, okay, much lower than our prior examples. And it stays that way until we need to make a draw from our HELOC to pay for gas, food, groceries, our living expenses. And what I'm demonstrating here, and you'll see two separate draws of $500 and $3,500 to demonstrate the fact that A, you're pulling the money out to pay for any bills that you can't necessarily pay out of a credit card. The $3,500 draw, what I'm trying to demonstrate there is that instead of using a debit card or to draw money directly out of the HELOC for expenses, what I would suggest is using a credit card that gives you points and miles and all kinds of perks. Use that towards all your everyday purchases. And by the time the final statement date comes around, you just pay it all off so that you don't owe any interest on the credit card, right? And what we've done effectively is we've delayed any kind of draw we're making out of the HELOC so that we can take advantage of the HELOC balance staying lower for a longer period of time, which means that we're paying a lower interest cost on a daily basis, right? 82 cents as opposed to dollar and some change. So this way we can delay any draws from the HELOC. We are also able to take advantage of credit card interest not accruing right away, and we earn some miles and points if that is your cup of tea. And subsequently, we're able to keep the average daily balance or daily balance really low to where our interest cost is now $32.53, as opposed to with the mortgage, it was at $45 of total interest. So when we look at the mortgage and the HELOC side-by-side comparison, both have the same starting balance, $10,000, same interest rate at 6%, and pretty much the same ending balance, right, at the end of the month, and the same amount of principal reduction. But how we're storing our money, what happens in the middle, right, what goes on throughout the month, can change how much interest we pay on either loans, the mortgage or the HELOC. So with the HELOC, again, we're able to take advantage of the daily interest calculation by taking our paycheck and putting it into our HELOC instead of leaving it in our checking account, pretty much doing nothing for us. And we have the same access that we would have with the checking account to make those draws to pay for expenses, gas, food, groceries, all the essentials that you need to pay for in a given month. And simply by doing that, we're able to reduce our interest costs by nearly 28%, right? But the same ending balance. So really nothing has really changed in terms of how much you're paying down, but the interest cost is radically different, 28%. And so the extra money that you're saving with the HELOC, right, the extra dollars may not feel like it's much, but that can be now added towards either further reducing your debt, therefore translating to even more interest cost savings in our subsequent months. So this is the power of using daily balance or average daily balance and have it work towards our favor in reducing the total interest cost and further accelerating the paying off of the HELOC and any other loans that you may have or paying off through the HELOC. So this, my friends, is the secret feature that you can use with the HELOC, right? I mean, the HELOC in itself is not really special, but how you use the tool, right? How you apply the HELOC towards our advantage could result in interest savings and further helping you pay off your HELOC faster, so you can become debt-free faster. And to give you another example, if we were to just use the HELOC at face value, meaning you're not really putting your paycheck into the HELOC or do none of that, right? You can see even bigger difference where if you just treat the HELOC like a typical mortgage, like a typical loan, it's really not going to do anything special for you, right? In fact, it may result in higher interest costs. And this is where most people will say, well, HELOCs are more expensive, yada, yada, yada. That is true if you're not using the tool in a way that gives you that advantage. But if we're able to use the HELOC where we're taking all of our paycheck, lowering the average daily balance or lowering the daily balance, that will and could result in interest reduction and savings, which is more money in our pocket. So there you go, friends. That is the secret feature with a home equity line of credit. If you currently have a HELOC and you have a balance and you're wanting to pay it off as much as possible and just reduce your overall loan payments every single month, this is a way to quickly reduce your HELOC loan balance and save the interest cost in the process when it comes to your HELOC. Now, if you already have a HELOC, chances are you may have heard of this concept of using a HELOC to pay off your mortgage faster. Now, if that's something that you're interested in and you want to pay off your mortgage, but also pay off your student loans, your credit cards, furniture loans, whatever other debt that you may have, I'm going to share a link to a separate video where I'm going to talk about how to use a HELOC to pay off your mortgage and other debt faster using this very same concept, the math that I just showed you, and saving you money and time in the process in paying down your debt and ultimately achieving debt freedom much faster. So what I'll do is I'll leave that link to a separate video in the video description down below. If you have any questions about this concept of using all of our paycheck towards paying down the HELOC, let me know in the comments. I'll be more than happy to address them or create a separate video as a response to help you unpack and learn deeper into this concept. So if you're interested in that, be sure to leave your comments and thoughts below. Leave a like for the algorithm and we'll see you in that next video. Take care.